either a brokerage account or a retirement account where it's otherwise challenging me to use that capital for Bitcoin. So it kind of opened the door for more types of pools of capital that can access Bitcoin. Obviously, the spot ETFs later did that as well. Um, it provides a way to have kind of like longer term leverage attached to Bitcoin, which can be a double-edged sword. But if someone is quite bullish on Bitcoin, having an entity hold a lot of Bitcoin.
Alden begins by highlighting a practical constraint that existed in Bitcoin's earlier years: accessibility. Before the introduction of spot Bitcoin ETFs, many institutional and regulated pools of capital had no straightforward way to gain exposure to Bitcoin. This limitation created a gap that companies like MicroStrategy helped fill. By adopting Bitcoin as a treasury reserve asset, MicroStrategy effectively became a proxy investment vehicle. Investors who couldn't directly hold Bitcoin, whether due to regulatory restrictions, retirement account limitations, or operational friction, could instead gain indirect exposure through publicly traded equity. This was a critical bridge. It expanded Bitcoin's reach into traditional financial systems, allowing capital that would otherwise remain sidelined to participate. Alden emphasizes that this model also introduced a unique dynamic: long-term leverage. Unlike margin trading or short-term leveraged positions that can be liquidated quickly during volatility, corporate debt structures tied to Bitcoin holdings operate on longer time horizons. This allows investors to express a multi-year bullish thesis without being wiped out by short-term price swings. However, she is clear that this is a double-edged sword. Leverage amplifies both upside and downside risk. She also notes a natural limitation. Not every company can replicate this model successfully. There is a network effect in capital markets. Early movers capture liquidity, attention, and credibility. Beyond a certain point, additional Bitcoin treasury companies add diminishing value. Instead, Alden suggests a more sustainable path: traditional cash-flowing businesses allocating a portion of reserves to Bitcoin rather than existing solely as Bitcoin-holding vehicles.
Well, I think from a first mover advantage, it makes sense to have. And before they did what they did, so there are no even spot ETFs when they began. So there were. I mean, I bought it. I bought this MicroStrategy Lyn in August 2020 when they started that strategy, because even though I held Bitcoin, I also had certain portfolios that literally there was no good way to get Bitcoin exposure. The closest thing before then was GBTC. And so I could say, okay, well, this is a way to express Bitcoin exposure in either a brokerage account or a retirement account where it's otherwise challenging me to use that capital for Bitcoin. So it kind of opened the door for more types of pools of capital that can access Bitcoin. Obviously, the spot ETFs later did that as well. It provides a way to have kind of like longer term leverage attached to Bitcoin, which can be a double-edged sword. But if someone is quite bullish on Bitcoin, having an entity hold a lot of Bitcoin and then hold various types of leverage or amplification that is not really like liquidatable on a, like, it's not like you get one bad price wick and they're liquidated on a Sunday evening. You have this longer term types of liabilities attached to it, allows people to express their kind of multi-year bullish view on the asset in a way that is, pretty safe, regulated, audited by a Big Four, auditor, trades on a major exchange, holdable in almost any type of account. I think that's the service that an early mover like that provides. I think there's a limit to how many pure play treasury companies that it makes sense to have, because there is somewhat of a liquidity network effect with those as well. If you're not kind of the first or second or third, you're not really adding a lot at that point. At least in that particular market. So it makes sense that any kind of big enough capital market, the US, Japan, certain European countries, Brazil, it makes sense they have their local kind of major treasury companies. But at a certain point, I think it's more interesting to have cash flowing companies that decide to hold some of their reserves in Bitcoin that are not just pure play Bitcoin treasury companies or nearly pure play. So I do think that there's room for a handful of those really kind of good and early ones. I mean, at the core of it, I think it's because it's the invention of fast settlements. So it's most technological innovations are layers on top of the current system. which is that almost every friction in finance gets solved by another layer of centralization, right? So if two people are having frictions doing finance, they say, okay, we're gonna use this banker. And so whenever whenever you sell me stuff, I can just say, okay, subtract from my account, put it in his account, and vice versa. Now, if there's multiple banks in a region, and we're getting annoyed by the frictions of what if you use a different bank than I use, then they start establishing kind of a central bank that kind of connects a lot of those banks and allows those to settle very quickly. And then when you have international operations, you say, well, we kind of need like a super central bank that a lot of ours can kind of connect to. And so you get like 4 layers deep of increasing centralization. And what's interesting about Bitcoin is, I mean, a lot of that is basically gold was slow. Any sort of like just settlement is slow. Transactions globally want to be very fast. So like I said before, we became increasingly reliant on these centralized intermediaries. And Bitcoin comes along and says, okay, you've had a century and a half of a technological mismatch of fast transactions but slow settlements. Here's the invention of fast settlements, meaning that you can send value in a way that is irreversible, and that no one entity can just reverse that transaction. So then you test it for years and decades. You see that it works, because I mean, you could propose the idea and it works for a couple years, and then some instability makes it not work. This is the first one that kind of had a lot of pieces together that really kind of made it work. The difficulty adjustment in particular was a massive step forward. There were attempts before, like the closest one would have been something like reusable proof of work tokens that Hal Finney had kind of put forth. Satoshi kind of continued refining ideas that were like that and made the system that works. And the significance of it is now people can on a decentralized network store value that can't be debased, and they can send value in a permissionless, decentralized way. And to the extent that grows over time, it's a pretty big competitor to the current way of doing things. It's at least an alternative. And I think it's the right solution, because when you look at the history of what makes one protocol win versus another, generally when a protocol becomes solidified, it's very hard to disrupt, and it becomes self-reinforcing. It's kind of like, why do we have Ethernet as our kind of primary networking protocol? Surely someone could make a slightly better one. I mean, it does improve over time, it gets faster. But the main reason is that no matter how good one you make, unless it's like an order of magnitude better, it can't compete with the fact that there's like already 10 billion devices in the world that have Ethernet ports on them. Same thing with USB. Same thing with building on simple mail transfer protocol or TCP/IP. When you get these protocols in effect, they have network effects that are very kind of self-reinforcing. And Bitcoin, it's kind of the protocol of value transfer, the protocol of kind of digital money. And the other thing that protocols have in common, first, you have that early lead, you kind of establish that dominance. But then two, the best protocols are generally very simple, and they generally scale through layers. So the core thing that no one can control kind of has to be really dumb and simple, because if it's got to be changed a lot, or there's a lot of variables that are tweakable, that kind of implies there's going to be a lot of governance there. And there's going to be kind of disagreements and more attack surface for how to tweak those variables. Whereas when you have the core thing be like just elegantly simple, and most of the complexity is pushed to the periphery, to higher layers, it allows that kind of core one to be very rarely changing in any material way. And you can kind of have it operate in an almost anarchy type of situation where there's no one really in control of it, because no one has to be in control of it, because it's not really something you need to change. It's just it's doing a very simple core layer thing. And I think kind of compared to other cryptocurrencies, Bitcoin really meets that definition. So the combination of early mover advantage, self-reinforcing network effect of liquidity and security, and then that really simple kind of dumb design are all features for why it can win.
Alden outlines a likely progression for Bitcoin's adoption at the institutional level. It begins with individuals and corporations. Then it moves to high-risk capital pools like hedge funds. After that, sovereign wealth funds may allocate a small percentage as a long-term investment. Only later, if Bitcoin becomes larger, more liquid, and less volatile, might central banks consider holding it as part of official reserves? This progression reflects risk tolerance. Sovereign wealth funds are designed for long-term growth and can tolerate volatility. Central banks, on the other hand, prioritize stability and liquidity.
I think it has to be an order of magnitude bigger. I mean, right now, since inception, it has served as an alternative, right? I mean, going literally all the way back to when Satoshi was still active and WikiLeaks got like their payment shut off by like PayPal and stuff, and they could start accepting Bitcoin. It became known as like this alternative that if you're debanked in any sort of way, or you want this alternative, Bitcoin is there. But as long as it is small, it's that kind of more fringe alternative thing that can be turned to. In order to actually impact the broader system, it has to be a pretty big mainstream alternative. Kind of like how gold is big enough such that central banks can say, you know what, we're going to hold fewer treasuries and we're going to hold gold at scale more. That moves the lever on the current system. And so I think Bitcoin has to kind of reach that type of scale to really have a meaningful change. And to get that scale, I think one is just time. So most tech can be adopted quickly. The problem with a tech that has a price on it is that if you adopt it very quickly, price goes euphoric, and then inevitably people build leverage on it, or they get overexposed, they get euphorically exposed to it, and then you inevitably get corrections that really disillusion a lot of people, break a lot of leverage, and take years to rebuild from. And so there's naturally a zigzag pattern of adoption that something like this has to go through. And then two, I think it just needs decades to kind of prove its technical security. I mean, right now the kind of the concern of the season is quantum. Other times, other seasons, it was centralization questions around mining, and kind of there's always like the question of how will security look like when the block subsidy gets very small. If adoption hasn't picked up by then and fees are very low, then maybe the cost to essentially the network won't be very high, and that could be a concern. So I think it has to mature in terms of kind of that tech ossification, where concerns have just been around for decades and it's still functioning, and the adoption's bigger, and then it can really start, I think, chipping into the current system. It has to kind of prove itself through more tests. I think it has the potential to be, in the sense that it is designed in such a way that it has that capability. Right now, it's a 17-year-old asset. It's currently under a $2 trillion market cap. At the higher end of its price point, it was over a $2 trillion market cap asset. So it's still, even on its best day, it's still fairly small in the global sea of capital. At the best, it was like 10 times. It was like a tenth the size of the gold market. Now it's like a 20th of the size of the gold market. Rough numbers. But what's interesting kind of for it is that, like I said before, one, it's a store of value. Gold gets debased by 1.5% or 2% a year on average. Bitcoin has no long-term debasement after it's kind of finite block subsidies kind of hit their ceiling. By the 2030s, we'll have like 99% of Bitcoin's mined. And two, when countries want to have these alternative payment systems that can't be shut off by external entities, Bitcoin's a fast settlement. Instead of literally just flying, planes of gold to each other, or relying on a credit-based system, which again can just be frozen or confiscated in many ways, a Bitcoin transaction can be sent and audited, depending on the size and how many confirmations you're looking for. Within the hour. And so there's basically both a settlement and a store of value aspect that's really valuable. I think the headwinds against it, one, is still too small. It's something that some countries can dabble in to varying degrees, but no country's going to say this is like very few countries say this is our primary reserve asset when it can go up and down by 80% in a very short period of time. I think they want to see it operate for longer, right? So there's always kind of new technical FUD in the way. Like people say, well, what about miner centralization? What about quantum? What about this and that? When a system's run for 17 years pretty well, they're like, okay, you have my attention, but let's see what it looks like at the 30-year mark. or the 40-year mark. And if it's 30 or 40 years, Bitcoin is much larger just because more and more private entities have decided to hold it. And around the margins, some sovereign wealth funds and central banks have decided to hold it. It can become more self-reinforcing over time as kind of if it continues to not be truly disrupted by technical threats. It kind of gets more and more Lindy. The Lindy effect kind of increasingly kicks in, as well as that self-reinforcing size and liquidity over time. And it makes sense that it would show up in sovereign wealth funds generally earlier than central bank reserves, because a sovereign wealth fund, the purpose of one of those is more for longer term investment. And so when you have a very volatile asset like Bitcoin, it doesn't match any of your liabilities. It can go up dramatically in price, or it can fall dramatically in price. It's generally not the asset you're gonna keep on hand for like working capital reserves, where you're gonna like sell some to backstop your currency. Instead, you're more looking at it as a longer term investment. So you stick it in something like a sovereign wealth fund, whereas the central bank reserves themselves, they're generally meant to be lower volatility assets, treasuries and gold and things like that, even currency deposits. And so I think it has to kind of climb that ladder in terms of how widely held it is, how much is that over time, increase the market cap, increase the liquidity, reduce volatility, keep proving that it can survive various technical questions or challenges. And then the more it does that, I think the more it can be attractive as a reserve asset. Actually, partially, probably yes. I think the interesting thing about Bitcoin is that it came about as early as it could have technology-wise, right? So it needed the world needed to have a certain amount of bandwidth for Bitcoin to work properly. In addition, it had to have the right types of encryption. So the encryption that Bitcoin uses, it was invented in like 2001 or something like that. So a lot of these pieces had kind of just fallen in place. And in fact, when Satoshi, in his initial mailing list, when he's like, "Hey, I have this paper here," and he's almost like it's almost like a thesis defense when you read those early emails before Bitcoin was launched, but when the white paper was out and he's discussing it, the other than how thinny, the response in that mailing list was pretty lukewarm or pretty skeptical, because a lot of them were like, "No, the scaling on this is rough. The bandwidth you're talking about is so constrained." And you'd imagine, if someone tried to make that 10, 20 years earlier, it's like the bandwidth, the amount of transactions you could settle in a period of time would just be super low. And a lot of the world just wouldn't really be able to even use it properly. So I think it kind of came roughly as early as it could have, like within a few years of how early it could have come. But I do think that, when you have the global financial crisis and you have other factors, it really does help sell the idea. The fact that he's able to timestamp a bank bailout into like the Genesis block, that's like immortalized, right? And then in the aftermath, as you have, throughout the 2010s and 2020s, people increasingly, they have lower confidence on average in their government. They have lower average confidence in major media, lower average confidence in the banking system, especially. The whole bank bailouts of the global financial crisis, you got the rise of the Tea Party on the right, Occupy Wall Street on the left, just as more and more kind of pushback against the kind of the establishment system. And I think that a lot of that did fuel Bitcoin. If things were working great and this technology came out, I think it probably would have had slower adoption than the fact that the tech level and the kind of where we were in that long-term debt cycle we talked about kind of coincided. That's probably the part that's pretty lucky.
Finally, Alden addresses why Bitcoin emerged when it did. Technologically, it required sufficient internet bandwidth, mature cryptographic tools, a global digital infrastructure. These elements only became viable in the early 2000s, but technology alone is not enough. Bitcoin's launch coincided with the global financial crisis, a period of declining trust in financial institutions. Bank bailouts, monetary expansion, and rising skepticism toward centralized systems created fertile ground for an alternative. This alignment between technological readiness and macroeconomic conditions accelerated Bitcoin's adoption. Without that context, its growth might have been much slower.